We're going to get started because it's just a little bit afternoon. And I want to introduce myself. My name is Alice Santos. I am the president of the Montana chapter of CCIM for 2025. So I'm just ending my year. This is our last educational event. We're going to have one more networking event in December 17th. That will be in Helena. We'll give you a little more information on that in your email blasts. But I really appreciate everybody jumping on this. I'm super excited because I like to be able to, we're such a big state. We have a difficult time getting any one meeting where people are included from all parts of our state because it's so big. Um, but some of you may know our mission at the Montana CCIM is to educate, have make excellent connections, personal and professional connections, and then also discuss investment opportunities and literally anything in between. We're open to everybody. So I'm pretty excited just looking at who's on this call. We've got folks from a lot of different disciplines. Today we're going to be talking about 1031 exchanges and DSTs, which is Delaware Statutory Trusts, very related. And we have Jonathan Barge from ACRUIT. He is going to be starting. Then we've got Rod Olson from Merit. And both of those gentlemen have sponsors for their company. Um, so I'm pretty excited that we have our sponsors being able to present like this. Let's see, with Rod, we have, I think we have both Rob Spiedel or Spiedel, I'm sorry if I'm pronouncing your name wrong, and Frank Felix from Inland Securities. And they'll jump in kind of a little bit after Jonathan. And we'll be talking about DSTs and the different kinds of investment opportunities. Let you go ahead and take over. I'm going to be a participant, so thank you.
Perfect. Yeah. Thank you, Alice. I appreciate the great introduction. And it's always, ACRUIT's been a sponsor of the Montana CCIM chapter, and it's exciting to see folks here too, potentially from as far away as Alaska. So I'm going to share my screen here and kind of get started. I wanted to just kind of start off and say that, I realize people are from different backgrounds and have different, levels of knowledge as it relates to Section 1031 and exchanging real estate. And you probably come from, either transactional knowledge or personal experience. But I also want to say that I don't want this to be, kind of a PowerPoint, just slide after slide after slide. I prefer it to be interactive. I've been to a few presentations lately where they're using this kind of Yahoo integrated like built-in question and answer, and this is really a lot of collaboration among the group, and it's not just slide after slide. And so I think I might start doing that in the future to kind of inject some fun into it and some group engagement. But this material can be interesting, and I encourage you to kind of either drop something in the chat or raise a hand, or so just let me know. Feel free to interrupt, is I guess what I'm saying, and make it a little bit more informal, so it's not just me talking about 1031 constantly. Here are some of the objectives that I'd like to cover today. We're just going to hit the basics and then go dive into the complex. But a good recap of the basics so you have an understanding and a framework so we can build from that framework and add in a little bit more, complex topics or scenarios or things that come up that you might encounter on a specific transaction, or maybe you've been involved in one prior and this is just a refresh for you. But we're going to talk about the qualified use requirement and the basis for even having real estate that's eligible for a 1031 exchange. We're going to talk about what's like kind real estate and how that is often a misconception in the way that it's actually defined, because the words like kind aren't very clear. You talk about the 45-day and 180-day periods within the exchange, the holding period, and the myths associated with that. You hear a lot of folks talking about like the 2-year requirement, or how long do I have to hold this real estate for it to satisfy the tests that the IRS and Treasury are going to use. We're going to talk about the same taxpayer requirement, which we do see a lot in exchanges, having different, not necessarily, it's a misconception because of the frequent use in investment real estate of limited liability companies for holding the asset itself, and often those being either disregarded or partnerships, but blending that together, multiple asset exchanges and different parties on title. How do you reconcile all that? Then we're going to talk about the use of the qualified intermediary and how that's a safe harbor in the regulations, and what our role is as a qualified intermediary, and then some of the economics. So we'll hop into it. I like to provide this just contextually, just to get a background for everybody to say, look, this, Code Section 1031 in its current form, has long-standing roots in the tax code. And then you can kind of see, going back to 1918, historically until the 70s, when you see this Starker case up here, historically it was a simultaneous swap, where you're swapping property, deed for deed among investors. And anybody that's been in the real estate community for prior to the 70s would potentially remember, getting around on a closing table and having the deeds transfer over, and having everything recorded simultaneously. That's no longer the case. Starker stands for the proposition that we all know today to be the 1031 exchange, where you've got this delayed period of time, right? You can delay or defer the exchange into this 180-day period, and those timing requirements would come with later revisions to the code. But prior to the 70s, it was this simultaneous swap. I say this to note that we all talk about boot and what is boot, and maybe you've heard the term before. It's kind of an industry term. It's an industry full of terms and acronyms and nomenclature and things like that. But boot is taxable, and I was told when I first got into the industry that a good way of thinking about taxable boot and when that would apply is look at the code and look at the history and say, property was historically exchanged simultaneously, deed for deed. If there was any variance in value, there would have to be cash, consideration handed from one party to the other, and they'd take that cash and they'd put it in their boot and they'd ride away on their horse, right? So that's one way of remembering, hey, that's the taxable component, because you received like for like property, but there was also excess cash on the side that you received, and that's the component that is taxable. Just a good way of remembering it. I like to look to the code and just unpack each of these words and provide a little bit more context of where we, the source of all the information that we kind of use for working through a 1031 exchange. But you can see that essentially what's going on in the way the code is written. I've highlighted or bolded some and underlined some words, but these are the kind of the buzzwords you hear. What is a 1031 exchange? Well, you're swapping property for other investment property, right? But that property must be held for, you can kind of see that in there, and it must be like kind, the property swapped, and the use of the property must be for productive use in a trade or business or for investment. And so when you look at this like kind standard, a lot of misconception, I'm on calls all day long with everybody from, the beginning exchanger, somebody's, this is their first transaction, or somebody who's more of a serial, and then they've done it, 10 times or more. And I can say with almost certainty that like kind is what they usually call up and they say, look, I want to swap. I'm selling, in this case, commercial real estate. Obviously at the commercial real estate level, they're going to understand or be a little bit more sophisticated with their investment knowledge, but it's a common misconception that like kind means I need to acquire other commercial real estate. And that's not what the code says, even though it's the way it's kind of written there, it comes off. Like kind is all about the use of the property and not the asset class. So you're just swapping that, and you're going to hold it in the same manner, meaning you're going to hold it for business or investment purposes. But you can see in here that when you look at the held for, there's no 2-year period listed in the code that says you must hold this for 2 years before you can swap it for other property. Just important to note. So it's all about the intent that you have that's in your mind, like the subjective intent. And the objective facts would be like how long you actually hold the property. Typically when somebody sells a real estate investment, there's gain built in, there's appreciation in value, and that difference between the basis and the ultimate sale price, there's going to be a capital gain. And if you aren't going to sell by using some kind of deferral mechanism through Section 1031, there's going to be a tax due on that gain. So there's recognized gain, realized gain, and what 1031 does is it essentially ensures a non-recognition of tax. Another important note is, especially when commercial real estate is involved, that you look at these different layers of taxation that are involved. There is, a common, I think, misconception in the sense that a lot of individuals who are selling real estate look to say, well, I'm just going to defer my gains tax. And that's what you hear very often is it's capital gains tax. But what you don't hear is the discussion about the depreciation recapture and the net investment income tax. And you can see I've got the state rate here. That's the California state rate, but it can be up to 13.3, and I think some of those are being adjusted this year. And you've got the net investment income tax that's triggered at certain thresholds. So if you meet, depending upon your filing status, if you meet those thresholds, there's an additional, I believe it's 3.8% tacked on to the tax of that gain. And then there's depreciation recapture tax. So it's 4 layers of taxation that are bottled up and deferred in a 1031 exchange. I will note that depreciation recapture tax would potentially be an issue if, say, you're selling a depreciable asset and you're only acquiring land in a 1031 exchange because you're not acquiring other depreciable assets. And so if you have taken depreciation on the property that you disposed of, there may be some depreciation recapture issues with that exchange. But in all likelihood, as long as you exchange equal or up in value and acquire like-kind real estate, you'll be able to defer these 4 layers of taxation. I will say that on a partial exchange, which we see a lot, and what I mean by that is, say your relinquished property is $1 million, just using round numbers, but you only acquire replacement property in exchange at $700,000. And so you've got about $300,000 in boot, or there, just round numbers, not including expenses and ordinary and customary costs. You'll pay. There's a partial exchange there, right? Because you did receive some, cash back at the end of the exchange that becomes taxable. The depreciation recapture rate is what comes off the top first. So the IRS doesn't say, we'll just tax the capital gains rate. We're actually going to go up to recapture. Once that's fully recovered, then we'll drop down into the lower rates there too for capital gains. So something to note on partial exchanges. Right there. And when you're selling a depreciable asset and only buying land in your exchange, replacement properties must be of equal, greater value so when you look at what is equal or greater value, the easiest way to say that is, you can kind of get into the weeds of subtracting out the ordinary and customary closing costs, and looking to equity and debt, but that does get a little bit confusing. So what I basically kind of start out, the conversation with is essentially what you're looking for is that purchase price of the relinquished property, the property that you're selling. That purchase price must be equal or greater on the replacement property being acquired, right? When you look at, yes, ordinary and customary costs come off the top, and you just need to roll over your equity and debt, that conversation gets a little bit untethered, because debt replacement in an exchange is a concept that I think a lot of people misconstrue. In addition to saying, not having a full grasp of what the exchange value is, you get a lot of this, misunderstanding of that. I just have to roll the capital gains. So it's using that sale example before, where we're selling for $1 million. Say our basis is $500,000. you get a lot of, first-time exchangers or people that aren't familiar with how the code works, thinking I just need to roll over my gain, which would be the difference between the basis and the sales price. And so they're looking to just reinvest their $500,000. And that is not when the exchange value or what we call the equal or greater in value rule. You'd actually run afoul of that, right? Because you'd be taxed on that other $500,000. The IRS doesn't allow you to, basically strip out your basis and then just roll your gain forward or segregate those two. They look for continuity of investment. So they want to see the equity and debt replaced in the new asset. You can replace debt with fresh cash or a blend or seller financing. There's a lot of creative ways to bring in new debt to the replacement property that isn't traditional, going through a third-party lender. So you can bring in a fresh cash infusion if you want to have your debt to equity ratios a little bit different as far as the ownership or the cap rates, but something to think about and always keep in the back of your mind. And it's something that also, even if they're not thinking they've just got to roll over their gain, when the net proceeds come into the QI account, they're going to get a summary, right, of the exchange. That's only accounting for what the net proceeds are, and it's not accounting for the debt. So if you have a client that's looking to make acquisitions in their exchange, they've got a live exchange, you're helping them find replacement property, and they're telling you, well, I've got proceeds, these are my proceeds in the exchange account. That is not the exchange value if there was debt associated with the sale of the relinquished property. So always thinking, equity and debt, continuity, rolling all those values forward. So there's 3 types of exchanges. A lot of different variations on these exchanges too. So a forward exchange is what we all know to be a 1031 exchange, where you sell first and then buy later, and you've got the 180-day exchange period. Then you've got the reverse exchange, which I don't like using the word, the exchange with reverse. It's just what we all know it to be. So that's kind of the way that we have these slides set up. But I like to refer to this as more of a parking arrangement. We're going to acquire title on your behalf, like using a special purpose entity, and hold that property, almost on the shelf for you to be acquired with your later 1031 exchange or your forward exchange. So there's a reverse exchange, and that is not an exchange at all when that closing occurs and the LLC acquires title. We're going to get into that a little bit further and kind of unpack it. And then there's an improvement exchange where you layer in the reverse, where a special purpose entity owned by an accommodator acquires title for you and then makes improvements to that property as well. So elevates the value, so then you can acquire it later in your forward exchange as replacement property. And those reverses can be structured, as you can see below, in a forward improvement model and in a reverse. And I'll kind of explain that a little bit in greater detail. I know it's a lot to kind of just throw out there for concepts. This is the important point. What essentially gets it all kicked off. If they haven't contacted a qualified intermediary prior to listing, the property or working with one of you, then it's vital, if it is going to be an exchange asset, to make sure that this cooperation clause gets into the real estate purchase and sale contract. So what you're doing here, and the reason it's important is kind of 2-pronged. One being the most important is that it's going to flag your intent to the IRS, right? Prior to even involving a qualified intermediary, you are essentially noting that, hey, I've held this property for qualified use. It's business or investment property. I've met the standard under Code Section 1031, and I intend to exchange it upon this sale. The other, so it's memorializing that, but the other component is it's ensuring that if there is a 1031 exchange cooperation clause in the purchase and sale contract, it's essentially assumed that there's a right of the party to assign the contract over, right? There's not going to be a bar to assignability, which would prevent the qualified intermediary from coming in and taking an assignment of the contract and getting the exchange moving. So you can kind of see the process, but we use closing days as day 0 for the exchange period. So that would start the 180-day countdown, and you can see how the proceeds Essentially, what's happening here is the qualified intermediary is going to take an assignment of the rights in the relinquished property purchase and sale agreement and receive obviously provide notice to the counterparty, provide instructions to the settlement agent of the exchange closing, and then receive the net proceeds into the qualified intermediary account. That starts the 180-day exchange period, first 45 days of which are the identification period. And then the qualified intermediary does the same thing in reverse, where they take the assignment of the new purchase agreement, whatever that may be, and then directs the proceeds to the settlement agent, and the exchanger acquires their new replacement property within the exchange period. Here's a different just look at the timeline itself, a little bit more of a detailed breakdown. Important to note, unless there is some kind of disaster relief or other type of IRS formal notice that's been published, there's no extension to this timeline at all, and it runs consecutive weekends and holidays. There's no break in between, so it is kind of a day by day countdown. And the qualified intermediary is really vital in that kind of first 45-day period for ensuring that the notice of designation or the identification of the new property is properly handled, right? So I know in our office we have a very detailed form that we send out, and we collaborate too with the exchanger to ensure that we're not only complying with the regulations, but also making sure that that you can see the regulations on the right, where it must be unambiguous in writing and submitted to the qualified intermediary. But there's also functional issues that arise as well when perhaps the exchanger's looking to be a co-owner in a purchase, and they're not actually going to be acquiring the entire property, or they want improvements to the new property and we're going to be using a parking arrangement. There's several different kind of variations on the theme or issues that come up that we have to work through in that period of time. So we only have a month and a half to do it. And making sure you've got a good reinvestment strategy out of the gate. Large macro way of looking at this, or a 30,000 foot view, is saying I kind of look at exchanging as a 45-day option contract. Because whether or not you actually acquire replacement property is one thing, but taking the option to try to defer the tax in that 45-day period is another. And that's some of the sophisticated clients that I work with. That's kind of the way they see it. They're like, look, I'm just going to open up the exchange, may or may not acquire replacement property. It's a minimal fee to do so, and it gives me the option to see what's in the market and make any acquisition if the chance arises. So, and go through due diligence, or at least get through some of the initial phases. And say, for instance, it doesn't, or you don't have suitable replacement property that you can find in that window because of inventory or other issues, then the qualified intermediary, if we don't get a notice of designation or a signed identification form, or the exchanger makes no identification to us in that window, then the next business day following that 45th day, the proceeds are released and the exchange is terminated. So it's not like the funds are locked up for the full 180 days. There are certainly scenarios where that is the case, given the way the ID process works. But it's something to keep in the back of your mind, is that bigger way of thinking is exchanges aren't that scary, and it can just be a 45-day option to get a deferral. This is just something I put on there. When you're looking at it from your lens, like how does this benefit me, perhaps in the position that I'm in? And you're looking at cash buyers, strict timelines. You've got, if you have additional knowledge in the 1031 space, which we've seen some brokers and agents really leverage that as a way to get listings and to kind of showcase their knowledge. They become more of the go-to for the sophisticated investors. And what I've noticed too is, and I'm sure you have as well, service and competency in one area can really provide a growth in spades, and some of these, not only on the referrals but also in the number of assets that one buyer or seller, or we call them exchangers, may actually have. And so when they're inbound in a 1031 transaction, as you're likely aware, say you're on the, the buyer side and you've got a exchanger, and or you're representing the seller and you find out that the buyer is an exchange buyer, you're starting to get a little bit more, kind of strategic knowledge on your side, because you realize, well, they're under a tight timeline and they've got proceeds to deploy, and so that's more of a benefit, right? So if you're helping an exchanger get through it, it can be very, very beneficial to your business as well. So what we do for the functions of qualified intermediary in Code Section 1031, there are many ways that you can exchange. They call them safe harbors, and the most common use of those safe harbors is the use of a qualified intermediary to get an exchange done. You can have qualified escrow agreements, you can have other different safe harbors, but I would say 99% or thereabouts of exchanges run through a qualified intermediary. And so what are our services, or anybody else that's a qualified intermediary? We're going to be on the regulatory side. We're going to be preparing the documents. I already talked about the assignment of the contracts. We're going to have the exchange agreement. We're going to be providing notice, and we're also going to guide the client through the process, and then bring in exchange officers that work through each stage of the exchange and coordinate with all the parties. So one thing that a QI cannot be is a disqualified party. So a qualified intermediary cannot be somebody who is the agent of the taxpayer for a 2-year look back period from the date of the relinquished property sale. So anybody that has an agency relationship with the exchanger, which would obviously be brokers of real estate and attorneys and things of that, like financial analysts. What is considered like-kind property? This is just kind of a good visual of what we talked about earlier. You've got the arrows going all the different directions. You've got the farmland, ranch land. So I guess keep an open mind, especially when it comes to easements. We see a lot of conservation easement sales in Montana. I would say that it seems like at least every other couple of weeks we've got a new conservation easement sale running through. A lot of folks aren't aware that a perpetual easement is eligible for an exchange. It's real property under the code. Billboard sites, cell tower sites. You've got wind and solar. So you see a lot of cell tower in Montana. The billboards kind of growing a little bit here and there, but wind and solar may be growing too. And you see Delaware Statutory Trusts down there, which Rod will talk about, and long-term leases. So, whether that's at an airport or something like that, or we structure these really creative ground lease construction exchanges. And the IRS has said, look, if the taxpayer has sold, fee title land or property, and they want to acquire a ground lease with a term that's 30 years or greater, we consider that to be like-kind real estate. So it's a lot more broad than you may think. There's a lot of ways of looking at what real property is, but the IRS did a great job in 2020 of really defining that in their updated Treasury regulations after they removed personal property from exchanges. So it used to be that you could exchange personal property like equipment and vehicles, planes, artwork, all that. But in 2017, under the Tax Cuts and Jobs Act, that was taken away, and all that was left was real estate. I think I've got some slides that talk about that here in a little bit in the future. So here are the primary identification rules and that you must comply with prior to the 45th day. The 95% rule is largely never used. It's there as kind of like a fail-safe if you break the other two. So if you can identify any 3 properties with no limit to value. If you identify 4 properties, you've broken the 3 property rule. And so you must use the 200% rule, which then I say, practically speaking, is you can identify any number of properties you want, as long as the aggregate fair market value of all those properties does not exceed 2x of what you sold for. And so obviously it's not like the dicker to negotiation price or like whatever you think you can get the property down to. It's the true fair market value. And then there's some kind of fungibility there is how that's determined. So I would say that in a lower value exchange, probably less than $1 million or thereabouts, maybe 1.5, that the three property rule really makes a lot of sense. If you're exchanging 2 million or greater, then the 200% rule can really add, you kind of expand your window of opportunities, because you're taking 2 million, you're saying now I can identify $4 million in real estate. And that's a lot more than potentially, three properties, depending upon what you want to exchange into. Or maybe maybe it isn't, but you can see how the 200% rule wouldn't really provide you a lot of leeway in an exchange of $250,000, because your 200% cap would be 500,000. So something to know, especially if you're inbound on an exchange. The 95% rule, basically, you can see it says there, if you fail the first two, you must acquire 95% of all the value of the properties identified. Very difficult unless you have identified a Delaware Statutory Trust, which Rod will talk about as well. But in that case, because you can kind of move the percentages around of the DST and hopefully acquire 95% of the property that went on your list. The same taxpayer requirement is important. Montana is a non-community property state. So when we were dealing with LLCs in Montana that have spouses as the two members, and then sometimes those LLCs are named after the real estate address. And it's often the case that the exchanger says, you know what, I've got this LLC, we own the real estate, but I want to acquire the title to the new property, maybe in a trust or something like that, or in another, or in my name individually. And the bottom line is there needs to be continuity, in the sense that the same taxpayer that holds the relinquished property is also the same taxpayer that acquires the replacement property. And like a spousal LLC in Montana is not a disregarded entity. So what we'd be looking at in that case is sometimes you can change who's on title, is sometimes not the taxpayer necessarily, such as the case of maybe like a single member LLC, where the tax reporting is done on the individual who's the sole member of that entity's return, right? It's disregarded. But the special note for Montana is that an LLC that's got two members, and those two members are spouses, that's going to be a partnership in Montana. And then any other two-member LLC, unless they're electing out of partnership treatment. And so all this to say is that the LLC is going to need to be the exchanger. So it's sometimes the case that a disregarded entity owns the real estate, but most often the entity or individual that's on the real estate to the relinquished property also must be the purchaser of the replacement property. And I'll talk about drop and swaps here in a bit related to that as well. So the 180-day purchase period, you can see that close means that's when the real estate was transferred. There's no closing escrow. There's no extension to the 180-day forward exchange window. And I think we talked about that already. The 45-day and 180-day, this is sometimes a point of confusion. People think, well, I have the first 45 days because we're so focused on this 45-day identification period. And people think, well, okay, I've got that done. Now I've got my 6 months, or I've got the exchange period left. And those are concurrent. So what you do have left is 135 more days after the identification window is over. And obviously the replacement property must be on the list. We get a lot of, hey, we're on day 47 or day 52, and the property I want is not on the list, but I want to acquire it in my exchange. Can I do that? And the answer is no. So unfortunately, the 45-day identification list cannot be changed after the 45th day or modified, and you cannot use proceeds to the acquisition of real estate that's not on that list. So really important. There's a lot of, I wouldn't say a lot, but there are some qualified intermediaries that, don't follow this rule as it should be followed, and could definitely jeopardize the taxpayers' exchange. I'm going to pause. If anybody, I'll take just a breather here. Check chat and see if anybody has anything as questions as we've been moving through this that they'd like to talk about.
I have something that I'd like to just add. Oh, hold on, my video went off. I have something that I'd like to add. You haven't mentioned it, and I noticed that it's not really mentioned in a lot of the education when you're talking about these, but
Yeah.
you can exchange multiple properties for one property. So going out, you have these rules of what you can name, but then
Yes.
going into this, so long as you can get it done in this time frame, you can actually sell multiple properties. It's not a one for multiple or one for one. It could be multiple for going in.
Fantastic point, Alice. Yeah, and we have relationships with very large real estate investment companies, and that's what they do on a very high level program scale, and they're disposing of, and they have it on schedules or calendars, and there might be like 20, even in one day or over the span of a week that they're putting into one exchange. And so great point. You can consolidate multiple sales into one acquisition. The biggest thing we look at in those scenarios is that identification window. Usually what we do if you are disposing of multiple real estate investments and they're all owned by the same taxpayer, meaning that we don't have to set up different exchanges, as we just kind of talked about the same taxpayer requirement, is we'll cut off the amount of properties that are going into the exchange at the 45th day. So essentially, like, hey, you've got one exchange, you've got the first sale, it opens, and you've got a 45-day countdown. So you've got other properties, 3 or 4 or 5 or whatever it may be that you're going to sell. Try to get those all done in that 45th day so the proceeds and value can go into the one open exchange, and you can consolidate that into one acquisition. That's a really good point.
But those sales aren't required to be done in a 45-day period, so you can close outside of that 45-day period for other sales. So that's not a requirement.
No, that's not a requirement. It's kind of our corporate policy, because I guess if you look at it practical speaking, it's not a requirement. But if you get other exchanges open, then you're stuck with the same identification that you were prior. So say in the first exchange, you identified 100% of the property, but you're consolidating from multiple into one. And then you open up 3 more exchanges, you still have those identifications you need to make. But your first one, the identification is wrong because you put 100 and it should have been maybe 25% of the one property. So yeah, that's a really good point. But I think overall, it's a really interesting to say. I think a lot of people just say it's one for one, and it doesn't have to be the case at all. I think Russell you give any details on an exchange property converting to a personal property following a different use over a period of time, i.e. exchange property becoming a primary residence. Yeah, and I think I might have that. I want to say I've got it here in a couple of slides. I may or may not, but that's a great question, Russell. And something that happens quite frequently, especially in Montana, where you've got investors coming in from other states, because the real estate assets classes in Montana, they're a little bit more limited than other, say, so the coastal jurisdictions or Texas or something like that. But essentially, there's a seasoning requirement. There's a specific revenue procedure. It's 2008-16, which basically says any property you acquire and you hold it for qualified use, for the first 2 years following your acquisition of that property as replacement property, you need to limit your personal use to no more than 14 days is the de minimis rule. There's some other use rules related to how much you rent it, but 14 days is kind of the de minimis. And then as long as you limit the use for 2 years and you hold it out for investment and it generates income, and you lease it out for a similar 14 days or more, then after that 2-year period, you can convert the use of the property into personal use. It can become a primary residence or a second or third home, and that does happen. And the inverse is also true. So say you move out of a primary residence, but you keep the real estate and then you rent it. So from 2 years following the date you moved out, then you can exchange that property. It becomes eligible. You've held it for qualified use. So you can do it to either property. You can season a property, or you can acquire a new one and then appropriately use it and then convert it. That's a really good point. So I would say on that, if it was your relinquished property and you moved out of a home and then rented it, then you could you still use the 121 exclusion, provided you were still in the 2 of the last 5 window, and you could use 1031. So hopefully that helped. Thank you for asking. And I didn't mean to Alice's point is fantastic, and I totally jumped into the weeds of technical identification issues that come up with that. But that's a really, really good point you brought up, Alice. So business or investment so you see holding bare land. That's the kind of the one pass that you get without generating income. You can just hold the real estate itself. It doesn't have an asset on it. Most all other property needs to have a business or investment nexus to it, which is memorialized by income generation and income reported on your return. The holding period, we talked about how, hey, the holding period, it says held for in the code, but it doesn't say held for X amount of time, and it's a matter of intent. So the IRS, the reason is the dealers and developers can't use 1031 because they're holding real estate as inventory for resale. So that holding property as inventory is not holding it for business or investment. And then flippers of real estate are the same. They're holding it for resale. It's a short-term hold, and their intent is to buy it and flip it, right? Maybe rehab it a little bit and then generate a profit. And then, dealers or developers of real estate also have business activity codes with the IRS that if they go to try to file an 8824, which is how you report a 1031 exchange, it's going to be a red flag on the tax return. So because they specifically aren't holding the real estate for qualified use. Vacation homes or second homes do not qualify, but I think we just talked about how they could and how you could season them appropriately by just understanding these rules. And then changing title or liquidating an entity before sale. Essentially what that's saying is, you've got one entity or individual or taxpayer, so to speak, that's on title to the real estate to be sold. That individual or entity has satisfied qualified use because they have met all of the standards in the code. However, if that entity were to transfer the property to a new taxpayer prior to the sale, just for purposes of effectuating a resale or for some type of cash out purposes, then that entity is not going to, or individual is not going to be satisfying the qualified use at the time of sale because they're not holding it for business or investment. They're just holding it for resale. And so that's something to consider. Personal use property, Russell brought us there. Here's kind of the rule. You can see it down below, the 2008-16, if you want more information on it and how to follow it exactly. But the overall takeaway is you're seasoning it and you're using it. You're limiting your use for personal reasons, right? The 14-day carve out is there for, just practical reasons, right? You got to get to the property. You got to do some maintenance on it, check in on it, but you're not inviting friends over, family. They're not staying there rent free. It's not your second home that you're claiming is truly an investment property, but you're there for 180 days out of the year, or whatever it may be. This is truly an investment asset, and you're limiting your personal use. However, once that period of time lapses, converting the use does not trigger a taxable event. There's no, exchange. You're not liquidating the property. You're just changing the way that you use it. So outward intent is key. You can see that's kind of a theme going throughout. So wanting to make sure you've got supported facts there. What happens when a related party is involved? So when a related party is either the seller or the buyer of the relinquished property. So you can start at the bottom. If you're selling relinquished property to a related party, that's perfectly acceptable. The issue comes up when you are trying to buy replacement property in an exchange from a related party. The reason the IRS bars this is because their concern is with basis shifting. That's the kind of rationale behind why they've excluded this type of transaction from the code. So it would disqualify the exchange if you acquire your replacement property from a related party. The related party rules are very complex, especially when entities get involved. But for purposes of our discussion, it would be, you're buying property from your brother or your sister or your parents or grandparents, so the lineal descendants. There's one exception. If you're going to acquire, most of the time we see it in exchanges is exchanger says, hey, I'm going to buy my parents' house so they can, move into a retirement home, or they don't need their house anymore. I'm going to buy it from them. And or somebody else in the family's got a personal residence, and that's going to be my replacement property. As we just discussed, that is not allowed. There's an exception in the code that allows for a related party transaction, but it also says that if you are going to acquire replacement property from a related party, they too must also exchange. So it's this domino effect. And if it's a requirement that the related party seller exchange, then it's also a requirement that related party seller also have that property for qualified use, and a principal residence is not qualified use, right? So that transaction would not be allowable. Related party, we get a lot of calls on this, and people want to, kind of bend the rules on it. I will tell you right now that when you go to file the exchange, because at the sale of the relinquished property, the settlement agent's going to issue 1099, and it's going to be reported to the IRS. There was a taxable event. You're going to go to the IRS, and when you file your return and say, hey, there was a taxable event, but I'm filing Form 8824 to request non-recognition treatment for the sale of this real estate because it was a 1031 exchange. They're going to say, great, fill out this form. Block 2 of the form is all about the acquisition from related parties, and it wants to know, did you acquire, it's kind of an opt-in. If you acquired your replacement property from a related party, check yes, then they're going to require detailed reporting, not only for you, but also for the other party. So I think I've hit that point home enough. Just remember, there is a minor exception to the rule, but more often than not, unable to be satisfied. This is a really good one for Montana. I like to include it in here. On one of the other presentations I have, the kind of the home site and the curtilage there it's kind of like a heart form, so it's even more unique than this. But run into this quite frequently, where you've got what happens with, and I know I talked about it a little bit with Russell, but what happens when you've got personal use property and you've got investment property on the same purchase and sale contract, and how do you deal with that? So what our process is, obviously, perhaps you could use the 121 exclusion depending upon how title is held. So if you've got, an LLC or partnership, so to speak, or not necessarily disregarded entity, or a corporation, which you see on a lot of farm and ranch transactions, like an S corp or C corp, those entities cannot own a principal residence in the eyes of the IRS. So that kind of throws those transactions out the window for mixed use. But say the property isn't in some type of corporate ownership, then what you do is you need to get a valuation on the current real estate, right? So you go to get a current market or like a broker's opinion of value, something along those lines. You've got to substantiate it in the file. And so what we do is we say, hey, not the listing broker, but maybe an affiliate or friendly broker or something like that agrees to come in and provide a opinion of value for the the home site and the area around it that's related to personal use and the home itself. And the landscaping, I've got other ones that have ponds and different outbuildings, and this is all part of the personal use for the enjoyment of this home, right? what is that value, and value this acreage here as rural residential rather than rural ag, and get us a figure. And then we're going to compare that figure to the overall purchase price on the contract. And then we're going to look to what the basis is in this home site here. And we're going to say, okay, well, how do you file? Are you a joint filer or single filer? Because the 121 exclusion is, $250,000 of gain comes off the table for a single, 500,000 of gain off the table for married filing jointly. So in this case, perhaps this is worth, we'll use $1 million again. Seems to be my go-to in this discussion today. But say the CMA comes back at $1 million, and they file jointly, and their basis in this is 500,000. So essentially, and the sale price of the larger property is say it's $3 million. Essentially, they're going to be able to take the 121 exclusion of $1 million off the table and just exchange the remainder as proceeds. So on the closing statement, we would actually allocate that as kind of like 121 funds to the exchange seller for personal residence, and then have the $1 million, and then you've got the remaining $2 million as proceeds to the qualified intermediary. So it's a little bit more of an art than a science. Once you've been through one of these or a couple of these, you start to see it. But a great way to know, just keep in the back of your mind, I would say commercial context, you're going to see it in these kind of where you've got the shop below and the home or the living space above, right? So you've got split use of the property, or so maybe some kind of duplex type setup, or you've got a larger shop area where multiple investments around, and those are maybe rentals, but then there's a home site there or some kind of quarters where that's the principal residence. So it can happen. You just need to look at the use that's happening and say, oh, well, we've got two different types of use. How do we actually treat that? Can we segregate it? And the answer is yes. We talked a little already about easements, leaseholds, and licenses. Easements being perpetual is the main consideration there. Question whether a 99-year easement is perpetual or not, given that you can acquire a tenant's interest in a lease as long as the duration is greater than 30 years. One of the big takeaways here, if you were to kind of say, well, how does this necessarily apply? We understand, let's look at the duration of the easement in the contract itself or the easement agreement. Is it perpetual? Great. We can use that. That's exchangeable. Is the exchanger acquiring a tenant's interest in a ground lease or other type of leasing interest that term is 30 years on its face? Or if it's not 30 years on its face, which you commonly see in airport authority type transactions, whether it be in Billings or Bozeman, is that the initial term might be 10 years or 15 years, but then it has options to renew within the lease agreement. And as long as those options to renew tack up and they are basically held by the tenant can strike on those options, and they hold that position, then those all can be tacked together to meet the 30-year requirement. The one thing I typically see is, a tenant's interest, obviously we've been talking about, is exchangeable, but a landlord's interest in a long-term lease is not exchangeable. It's not eligible real estate. The IRS looks to that and says, yeah, it's an income stream. That's not real property. One way that we've seen creatively used, so say it's a cell tower, or you've got the solar panels here, and you've got this long-term lease, perhaps, maybe, and then the tenants put in the panels, and the landlord's getting an income stream for the use of their property, and they're saying, well, I've got this offer to sell my interest in this lease, and I want to exchange the value from that sale. How do I do it? And we just said, well, landlord's interest isn't exchangeable, so what can we do? Well, perhaps we go to our friend the easement and we say, maybe the conveyance of your interest in the lease as the landlord can be structured as though you're selling a perpetual easement to the buyer. So that's one way of looking at it, but that happens. So just being able to understand the different uses of the property, the different types of real estate that can be exchanged, and the positions that they're in. So just one thing to not overlook, potential exchange value here. We talked about kind of stocks, bonds, notes, securities, partnerships, fix and flips. These are not like-kind real estate. I see this often: real property inside the U.S. versus real property outside the U.S. That's not like-kind. We have tax treaties with certain countries, right in the Gulf or in the Caribbean, and those can be applicable for real property U.S. swaps, but you can't go from England to the United States or something like that. It's not like-kind. Fix and flips, certificates of trust, interest in a partnership. This happens very frequently where we get a call and there's 4 members in a partnership and they're selling commercial real estate and they all want to go their separate ways. So can I exchange for my sale of my membership interest in this? The answer to that would be no. You need to have a direct interest on title. So it brings up conversations around dropping the property out and then swapping it in an exchange. And then obviously stocks or bonds, notes, other securities, those don't apply. You can't go buy equities with 1031 proceeds. We talked about the reverse. So I want to get into reverse and improvement a little bit. What is a reverse and why do we facilitate it? So I would say that if exchanger wants to use proceeds to build improvements, either like tenant improvements or build a new asset or actual building on the property, whether that's a single family home or commercial building, that's when we're going to park title. We're going to use an exchange title holder to go acquire title on their behalf using either cash from them or third party financing. And we're going to build out those improvements to spec. Or the relinquished property sales falling apart. So, hey, I was inbound. I had a contract to sell my relinquished property and I used kind of the good faith of that buyer to go out and get into contract for my purchase. And now I'm obligated to close on a purchase transaction and that is going to be my replacement property, but that closing is going to occur before I actually sell. That's when a reverse exchange or parking arrangement comes into play. Our LLC acquires title using your cash or bridge financing, holds it for you on the shelf to allow you additional time. So it's a time mechanism there, allow you time to sell the relinquished property and engage in a 1031 exchange and acquire that property from our accommodator. And then you can see market conditions or advantageous acquisitions. I would say advantageous ones, where you've got really good terms and the contract's assignable and you're looking at long due diligence or LOI, or you've got a tenant in your relinquished property, but this perfect acquisition came up. You want to jump on it. It's a good, knowing that you have the tool available to engage an accommodator to acquire title on your behalf is great. And I'm starting to see more and more use of it. Yeah, maybe it's just my position at ACRUIT, but it's very popular, and especially for income producing property, because you can offset the costs of the short-term bridge financing with, the rents are going to flow directly. We're going to triple net the property back to the exchanger and allow you to collect the rents. And so it can be kind of a cash flow, cash equal, or even making good income during the period that we're parking the property, even though you haven't sold the relinquished property yet, or market conditions where you're dealing with inventory. I don't need you to memorize this, but this is kind of a good overview of, there's a lot of moving parts in a reverse exchange. So you can see where you've got the different parties, the lenders involved, you got the intermediary, you've got the exchange accommodator, and the different rights and contracts between all the different parties. So this is what a typical reverse exchange looks like and all the moving parts. But we're here to make it a little bit easier. But yeah, so say you've got a large commercial project and you've got the land under contract and that's closing. You don't intend to sell the relinquished property for a while and you want to do a lot of significant build outs. Your exchange value, remember we talked about that, the equity and debt in your relinquished property, say it's $5 million, but this land acquisition is $1 million. You want to put $4 million in improvements in the property. So then you can have an equal or greater exchange. Accommodator comes in, acquires the land, and we cycle the invoices through the entity, and we use interim financing to build out these improvements. Within 180 days of getting the exchange value in the ground, so say we've got 3.5 million in or something, then you look to triggering the relinquished property sale. This is essentially what I was just kind of outlining. Is this? There's two ways of doing a reverse exchange. There's the one that says, hey, you've got to, from 180 days from the date that the accommodator acquires title on your behalf, exchanger must sell relinquished property through the qualified intermediary and then acquire the title back from the accommodator. That's the safe harbor in Revenue Procedure 2000-37. Embedded within that in Section 3, you can see that the IRS is saying, look, we've set these rules out. If you want a non-question transaction, you follow these rules. But we also agree that no inference is intended with respect to the federal income tax treatment of parking transactions that don't fit this mold. So we're not going to make a negative inference. So that essentially opened the door for these longer term arrangements, because you're probably thinking in the back of your mind, well, how are you going to get $4 million or $3 million in improvements done in 180 days? And practically speaking, that's somewhat, more on the rare side. So we use this as a mechanism to hold title for greater than 180 days. You've got reverse exchange issues. You got tax accounting. I would say that some of the biggest ones in like farm and ranch are like the water rights and issues and permits and leases. But on the other side of this would be, working with lenders, making sure that they understand the complexity of the transaction, understand the nature of the ownership and how the accommodator works. And then really, I thought I saw Bob on here. I don't know if he's here or not, but maybe saw him log in. But working with sophisticated lenders who have experience in these types of transactions and making sure that they have all the the organizational charts and entity documents, because we're going to have to be underwritten as part of the process. So lots going on, but definitely worth it in the long term. When you look at the 180 days, again, can you get the permitting and pre-construction done? If you're looking at a jurisdiction like California, you're likely not even going to be able to get a permit done or finished up within 180 days. So it's going to be longer term type of arrangements. These are just other ancillary issues that you need to consider as part of the overall process. These are a lot of it is just overall construction, common issues with construction anyway, or building in Montana and Alaska in the winter. And then obviously coordination with the forward transaction, making sure you're not thinking you're keeping in the back of your mind that this parking arrangement is not an exchange at all, and that ultimate sale of your relinquished property is the 1031 exchange. And so I think that's where I've got it kind of on my side as far as a little bit of a wrap, but I'm happy to take any and all questions and we can kind of dive into areas further. I'm hopeful that you have some.
I have a question. This is Alice again.
Yeah.
So you mentioned it when we were chatting last, and I just want to clarify it in my own head. So if you're selling a property, you're selling multiple properties. You've sold the first property, and that starts the 45 days.
Yep.
Okay, so you get to say 43 days, you fill out your form and you send it in. So because if you're like me, you don't want to wait till the last day.
Yes.
And so you've sent that in, you have identified your property, and then you know that one of the properties you're going to sell is going to sell right before the purchase of that other property. So it is going to go past, there's no naming like we talked about it. I just want to kind of make sure there is no naming of the properties that you're selling except for to let the QI know that it's happening. Because that can get turned around. Like there's no waiting period, right? The money goes to the QI and then like the next day can go to a purchase, correct?
That's right. Yeah, sometimes we can do it same day, even if it's similar escrow, or we do a letter of direction where we just tell the settlement agent on the relinquished property to circumvent our accounts and send it directly to the purchase escrow. Yes, that can
So
happen.
you don't have, so 45 days isn't the time period that you have to sell all the properties that you want to sell. You can extend that just but you need to name the properties that you're going to acquire within that 45 days, the first 45-day period.
Yes. So if you're selling multiple properties, then the first sale triggers the 45-day countdown. Yeah. And then if you want to bundle all those properties into the same exchange, that's perfectly fine. And my scenario before was say you didn't you weren't going to meet the timing requirements, and you wanted to sell more properties, and you maybe had two exchanges open. I was just saying, if you're already at close to day 45 or at day 45 on the first exchange, and you're going to use another exchange to acquire the same property because you're selling multiple real estate interests. What I was saying is, in each individual exchange, you're required to make an identification. And if that identification is 100% in one, then it can't be, another fraction or 100% in the other, right? One of the two is going to be a fail. That's all I guess I was getting at.
Yeah. Oh,
Yeah.
I get it now. Thanks for clarifying
Yeah.
that.
Sorry to kind of go in circles there.
No, no, that's okay.
I appreciate the questions though. I know I see Julie in there. I'm sure there's other people that I've worked with that may or may not have questions, but I'm happy to answer them. And even, obviously Rod's got some information he wants to cover and kind of really dive in depth on DSTs, and that might trigger some more 1031 clarifications or discussions. And I'm happy to be here for that as well. But I suppose I can hand it over to Rod for now.
Jonathan, Rod here. What do you see happening in the markets? What do you see? You seeing any movement?
I think that's a great question. And I like to always kind of cast it along to my other relationships as well, whether it be brokers or attorneys or, tax advisors or financial advisors. But I think what I'm seeing is a little bit of there is a rush. There's that end of year rush, right? For like the tax straddling, so to speak. So when we're looking at the 45-day period or the 180-day period, if you sell after November 17th, then even if your exchange fails, the taxable event could be in 2026 because you've straddled the tax years, and so you can take installment sale treatment. So we see a lot of that strategy this time of year. I'm seeing a lot more, relinquished properties that are on the market and they're not moving, and maybe could potentially hear more feedback from the rest of you on this call. And so that's forcing the hand of the investors to say, well, I've already decided my next move, and I'm now under contract to make an acquisition, and I'm going to get the accommodator involved. So a lot of reverse exchanges coming in. I think there's also kind of, you've got the Fed speak, you've got the different rate questions, and different seasonality too. So now we're in the more of the Montana off season, and then in the interim, perhaps we're going to get a couple of rate cuts. I don't know if that's going to affect long-term rates or not, but I think there might be some sideline approaches as well. There's a lot of cash on the sidelines, and maybe the market really gets moving heavily. March, April. I don't know if we're going to see like a COVID or pandemic level type of market spike, but I think that's generally what I'm seeing. I don't know if you share or have the same experience.
I think that's pretty fair. I know that Frankie is here from Inland to join us and talk about DSTs a little bit, but they've seen some bump in the Southern California market, slight, but
yes.
I'll let him touch on that one. So, hey, I apologize. I don't. Go ahead.
No, I agree with the California market. without a doubt.
Yeah.
A lot of the transactions that I'm currently working are in California.
Mm-hmm. Good. Good. I apologize. I don't have a camera working today. The camera and I have been fighting for the last hour, and I don't think I've won that battle. But I, my name's Rod Olson. I own, operate Merit Investment Services. We work very tightly with a number of different sponsor companies out there that put these DST projects, Delaware Statutory Trust projects together, and Frank represents one of those companies, Inland. They do a pretty responsible job with the projects they bring to market. As an independent financial advisor, I'm also tax licensed, and so we kind of blend that whole conversation together when we're working with individuals that are at least considering or wanting the education about a DST and whether that's a useful tool for them or not. So we've been doing this for, I was looking at the calendar, I think 14 years we've been having this conversation. So we've got a little bit of experience in the market. Frank, do you want to give us a little background on Inland and maybe share a little bit more about DSTs? And I might jump in with a question or two just to spur on conversation.
Yeah, definitely. Thank you guys for having me today. My name is Frankie Felix. I work at Inland Securities. We're one of the top DST sponsors in the country. A little bit of background on us, kind of a long story. We've been in business, in the real estate business, for over 50 years. We were actually started by 4 teachers in Chicago in the late 60s. They weren't making too much money teaching, so they wanted to get into real estate on the side to make some extra cash, and ended up becoming extremely successful, creating Inland as it is today. We're actually the 7th largestly held private commercial real estate owner in the country and the 8th largest land owner in the country, also privately held, and helped formulate the DST when it came out in 2004. So in regards to the whole investment world, the DST is still fairly new, just over 20 years old. But we've been in the game since the get-go, and we partner with financial advisors throughout the country, Rod being one that we partner with closely to educate people on these offerings, the advantages of them. And I'll go over a little bit more on the ideal client that this would be useful for. It's not going to be for every single person that's wanting to get in real estate, wants to invest in real estate. It's a very small, specific niche. But once you can identify that niche of client and capitalize on it, I think it can definitely benefit you as a realtor, because it'll give you an extra tool in your tool belt. I can definitely share my screen, Rod. Let me just get that up. I got a small presentation for you guys. There we go. Can everyone see my screen all right?
Yep.
Okay,
Yes.
great. So these are real estate investment offerings. Just always make sure to read proper due diligence and PPM when reviewing them. This is just a quick picture of the 4 founders that I mentioned earlier. 2 of the 4 are actually still working with Inland today, very much involved in the company. We are an owner, operator, and manager of institutional quality real estate. We deal with private placements, institutional funds, REITs, securitized 1031 programs, which are the DSTs. A great track record spanning over 50 years. We've done over 300 sponsored programs. We have acquired over 900 properties. We've taken almost 5 billion, maybe a little over 5 billion, because this is data as of end of 2023, of full cycle programs. We have about 80 billion in assets under management and done about 18 billion of acquisitions and transaction volume. We dabble in real estate throughout the entire country. These are, the main markets that we like is Arizona, Colorado, Florida, New Jersey. We are headquartered in the Midwest in Illinois, so we like the Midwest market, specifically Illinois and Minnesota. We've dealt in significant amount of sectors. The main ones that we like to focus on today are self-storage, senior living, student housing, and multifamily. We've steered away, obviously, from office, retail, We like industrial, but don't have too much focus in it. But those are the main sectors that we like to acquire today. We call those the alternative sectors of real estate. A lot of the time when people think of commercial real estate, they think of the multifamily, hospitality, industrial. We're transitioning our investment focus into that alternative, which is that self-storage, student housing, senior living. So I know Jonathan reviewed the process of the 1031 exchange. So as you all are well aware, it's one of the greatest tax codes to help defer taxes on appreciated value of real estate. And the DST is a great solution and alternative, which you'll learn to the 1031 process. The DST actually helps make the 1031 exchange process much quicker because we have these properties already have pre-approved due diligence, not once, not twice, but 3 times by the time it hits the clients and investors' eyes. We have pre-approved financing on these properties, and we have a constant rolling inventory throughout the year. So the DST timeline can actually be much quicker than utilizing that full 180 days during the 1031 exchange process. The DST does fall under the like-kind umbrella for real estate because these are properties being held for investment or business use. Typically, these DSTs are structured in one of 2 ways. They are all specifically within the same asset class. So if it's a DST, it'll be one in multifamily, or it could be one in self-storage, or it could be structured a multi-property in a couple of different states, also within the same sector. So it could be a 3-property self-storage facility in Texas, Arizona, and California. Could be a 3-property multifamily in New Jersey, Florida, and North Carolina. It just depends on how our acquisition team wants to structure these deals, but you do get a varying different amount of geographical locations and asset classes as well, all coming underneath that like-kind umbrella. So as you're well aware, 1031 process, client sells a property, capital is held with a qualified intermediary, where it then starts their 45-day ID period, calendar days, so that includes holidays and weekends. While when it comes to the DSTs, while your client's money is with the QI, this is where you're going to engage with conversations with Rod, because we have our offerings available through him and his financial investment platform. Rod will then be able to speak with your client on which DSTs Inland has available, which geographical locations, which asset classes, the distributions that we're paying, if they need a certain leverage replacement upon their sale. Once your client then figures out which DST they would like to go into, they can identify that DST will then with the QI, and then they will finish their exchange as soon as they submit their subscription agreement to our back office, where they will then receive a beneficial interest within the DST. And the nice thing about these investment solutions is that, I believe Jonathan mentioned it, where they could pretty much get an exchange done within, a couple days of the identification period. Well, these DSTs are stabilized income producing assets when we acquire them. So your client, if they identify a DST on day 1, and get all their subdocs and everything completed within day 3 or 4, they could be receiving income on day 5. So pretty much instantly once they get that transaction executed. Compared to if you're looking at a local piece of real estate, you need to go acquire maybe a single family home, or you're looking at acquiring a quadplex or a duplex. You have to go out and you have to go find those tenants to rent out those spots. And so it could be a little bit of time before your client starts to see an income from their investment property, compared to the DST, whereas they can see that instantaneously once they execute on that transaction. So the role of qualified intermediary, I know Jonathan did a great job explaining how important the role they are of the QIs during the 1031 exchange process. Here's just the timeline again of the 1031, identified by day 45, closed by day 180. I'm not sure if Jonathan, because I copped in a little bit late, touched on the three property rule, but you do have the ability to identify three properties upon the sale of one property and have the ability to identify 200% if you want to identify more than three properties of the sale proceeds. And over the past couple of years, since 23, 24, and this year, especially with the struggle that the housing market has gone through, the lack of exchange volume, high interest rate volume, or high interest rates, we've advised investors to identify a DST as a backup option, even if they have a local piece of real estate identified as one or two, just because a lot of things can happen. Maybe investors don't get approved for financing. Maybe the seller backs out, a natural disaster comes in and wipes out the property that they're looking at acquiring. 45 days is not a lot of time when you think about it, about a month and a half, and a lot of different things can happen and those properties can fall through. And having the DST identified as a backup option, and I'll kind of re-go over this when I get more into the DST, can be a saving grace, especially in times of uncertainty in the market. Because if something were to happen on day 46 or after day 45 and you don't have another property identified, your exchange could be blown, your client's gonna have to pay tax, and everyone's unhappy. With the DST, they could have that backup option. Their local properties could fall through, but they have that DST as a safety net where they could continue their exchange into that property and still receive income and defer the capital gains tax on that exchange. Some of the do's and don'ts of the 1031 exchange guidelines. The new asset value must be equal or greater of the relinquished property. So in order to fully defer the taxes on utilizing tax code 1031, your replacement must be acquired at equal or greater value. Another requirement is that the cash invested in the replacement property must be equal or greater to the cash received from the relinquished property. And I'll get into that a little bit more because these DSTs have a unique feature where we have leverage on these properties. And so some people think that because they're leveraging up, they could pull out some cash tax-free. That is not the case. All the cash that you receive from your relinquished must be exchanged into your replacement. And then the debt replacement on a property must be at equal or greater value of the debt from the relinquished property. Like I mentioned, I'll get into that in a bit, going over the advantages of the DST. So, like I mentioned earlier, your clients and investors will receive a beneficial interest within these properties. What I mean by that is that the DST allows up to 500 unique investors. And these investors do have to be accredited, and Rod will take those clients through the accreditation steps to make sure that they qualify for these investments. But because the DST allows up to 500 unique investors, it permits for fractional ownership where multiple investors can own a percentage of these properties. So think of a property, a DST, as property or portfolio of properties of 70, 80 to all the way up to 150 million in size. As a typical real estate investor, that's the goal. That's the goal that everyone wants to get. Everyone wants to acquire that $150 million property in that portfolio. But a lot of people won't or can't have the ability to acquire those or put a down payment for them. The DST allows for fractional ownership. So, for example, if a client has $1 million property and they're looking at selling and utilizing tax code 1031, they could sell that investment property and exchange into a DST. And if that DST, for example's sake, is 100 million in size, they exchange that million. They own that DST 1% outright. They own 1% of that building. And they partake in the cash distributions on a percentage basis and the appreciated value of the property as well. One thing to note is that it's very important when it comes to DSTs to partner up with a sponsor that you trust, has great experience and a great track record in the space. Because the sponsor is responsible for the day-to-day management and taking care of the property overall. The investors don't have much say when it comes to decisions, and there's two sides to the coin, and I'll get into that. And it's because there's up to 500 unique investors. Imagine 500 individuals trying to decide on what to do with the property. Nothing would get done. So this is under the responsibility of the company or inland to take care and operate this property to their best ability. So there's three phases of an DST. First is the acquisition and subscription. This is where inland goes out and buys a property, puts it on our balance sheet. We pretty much structure it into the DST form, and then we release it out to the public, or not the public, but through financial advisors to investors, to where we then have them subscribe or exchange or cash investments into these portfolios. Once we raise that last dollar, it will then start a time frame or a period where the investors will be receiving distributions. We will operate the property to our best ability for it to appreciate in value, and that is during phase 2. That typically is anywhere from 6 to 8 years that this property is going to be held. And then once we are looking at selling the property, we go in and sell it, put it on the market, find a purchaser, send out notifications to all investors and financial advisors that we're looking at selling this property in the next 60, 90 days. What would you like to do with your proceeds? They have the ability to opt in to do another 1031 into a DST. They could do another 1031 into a local piece of real estate. They could cash out, pay tax. They could do partial exchanges. So they still have the optionality and ability to direct their capital as they would like within the real estate industry. Just reviewed all three of those phases. So here are the key benefits of the DST that I wanted to get into. This is a very unique investment offering. And like I mentioned, it's going to be for a small niche of real estate investors. And once you have the ability to identify those small niches, I think it could be a great tool for you guys. And the first is that there's no management responsibilities. A lot of people love real estate. There's a lot of benefits, tax sheltering, write-offs, things like that when it comes to real estate. But the biggest headache of this asset class is the day-to-day property management, the calls at midnight about a pipe bursting in the laundry room, or you need to get the roofing replaced. That's going to cost a significant amount of capital. And it can slowly build to be a lot. And this is where the DST is great, because it doesn't allow for any management responsibilities, because like I mentioned, it's the sponsor who is responsible for the day-to-day property management. So this allows the investors the opportunity to no longer partake in what we call the terrible T's, dealing with the tenants, going to collect rent, dealing with the trash, dealing with the toilets or the termites, all the headaches and repairs and unexpected expenses that come up during and while operating and owning real estate. But they have the ability to enjoy the terrific T's, what we like to say. They have more time to travel. They have more time to spend with grandkids. They can go play tennis or pickleball. They can go on a 3-month cruise and not have to worry about getting a call from the renter. So it allows them more freedom, because this is a passive investment strategy. You go from an active in real estate to a passive in real estate strategy. They are still receiving a distribution on a monthly basis, so they will still have a distribution sent to their account as it would owning property themselves. And they partake in the appreciated value of the real estate as well. So, the expectation that real estate appreciates over time, their principal investment will also hopefully appreciate over time. Next is that they have access to institutional quality properties.
Frank,
Like I mentioned, yes.
Frank, can you address liquidity? As long as we're talking about income and how they get cash, somebody shows up, they're into it 2-3 years, and they say, "I just found something down the street." Can you speak to why they're built to be illiquid?
Yes. So these are illiquid investments. Like I mentioned, these holding periods are anywhere between 6 to 8 years. And it's because you're a small beneficial ownership of these properties, and it's for protection of the property in itself. If we had individuals exchanging in and out of this real estate on every 1 to 2 years, it would cause instability within the program. And also, we have to hold these programs for at least minimum 2 years to accredit or apply for the intent to hold as an investment property. And while we're holding these properties, like I mentioned, we're operating these, we're trying to get manage these to the best of our ability to get the best dollar when we're looking for a sale of the property. So if you do have a client that comes that says, hey, I would like to get out within 2 to 3 years, unfortunately, they won't be able to do that. Because if you have one investor do that and you let one investor do it, then you'll have a significant amount of other investors do it. And another reason is they have to be accredited. So if they want to sell their portion of the DST, well, they can't just go put it on the open market as you would listing a property on Zillow. There are qualifications as an investor to exchange and invest into these properties. So that also adds a hurdle for them to finding a replacement buyer to purchase out their portion. So these are illiquid, 6 to 8 year holding period. So with clients that are interested or looking to get out of day-to-day property management, just let them know that their money is going to be locked up for a duration until they can move forward and exchange again. Any other questions on the illiquidity factors of the DST?
No,
Yeah,
I don't. Okay, go ahead. Sorry.
so maybe you said it in the very first sentence, but so if you, let's just say what is the time frame? Is there a minimum time frame that's set out when you're signing on that says this is when you can get out? Or do you have to wait until the property is sold by the holding
Frank, can I
company?
get that?
Yep, go for it, Rod.
Um, There, Delaware Statutory Trust law says that if the project is wrapped with debt, it has a 10-year lifespan. It cannot go beyond that. Ideally, where these projects are right now is a 5 to 7 year. Five, and you said 8, Frank. That's the timeline. And somewhere along that line, they're looking to take the property and do an exit for clients. If we had been talking pre-COVID, things were moving very quickly, and it was really 3 and 4 years. It was pretty quick. Interest rates, we know it has slowed everything down, and these are certainly no different. If the property is debt free, and a lot of these DST projects that we've been doing, I say we, I'm raising my hand here, uh, that we've been doing in the last 2 years are debt-free projects, or people are coming with no leverage. Uh, those projects actually could go to the 11th, 12th, 14th year should the markets not be right for a liquidation. Now, their intentions are that 5 to 7 year window, but if things were not correct in the markets, there's that ability to go a little further. They're not going to hold it forever, but that's a potential, and that's in some ways needs to be looked at as a safety valve for clients. Does that answer your question?
Yeah, basically, when you sign on to DST, you're on for the period of time that is decided for you. You can't like have an event happen. Well, I don't know, maybe if a death happens, then it triggers something. But if you don't have something where you've just like have to get out sooner, you're out when the investment itself tells you you're done. When
That's
they go to
correct.
liquidate. Okay, that
That's
clarifies.
correct.
Thank you.
Oh. Say mom and dad sold their multifamily situation. They DST went to a DST, and dad passes away during that hold. Mom would get a step up on his share, just as normal tax law says. Uh, at the liquidation event, mom could pull his monies and have those tax free, just as we would with any other commercial property or income producing property. So tax law is identical in that sense, too. So if both parents passed or ownership passed of those, kids would get step up, or however the trust has things set up. That step up's going to occur. Those are preserved, and so that's what this whole thing is about. Being able to avoid tax, and that's the tools.
Okay, thank you. That does explain that. And then I also have a question. I don't know if this is the time to ask it, but what is the typical return? And I know that there's probably going to be a range, but what's a typical return on DSTs?
Yeah,
or
so
is
it's
there?
gonna depend on asset class for sure because depending, we have some assets that perform historically better than others. But on average, for all the deals that we've taken full cycle, it's been about 8 to 8.5. So with a conservative 4% distribution on an annualized basis and a 4% appreciated per year, our annualized return for these DSTs have been around 8 to 8.5.
Okay, and I see
Clients,
Julie just asked that same question, so hopefully that answers that for Julie.
yeah, clients get depreciation, so that takes up 4.5% or 4.75 and juices it up a little bit. Um, they're getting depreciation with that. Comes on a Schedule E, so it stays there. And their tax person's always going to have questions the first year on how do we do this, and we can walk them through that.
Definitely.
I have a question too that just follows along with that. What kind of risk traditionally are you guys seeing with this as compared to? I mean, obviously there's a bunch of different investments that people can take, um, and say percentage wise, what would you put the risk portfolio at in comparison to say someone who looks at your 8% and says eight's not that great when I can go and get a stock worth 15%.
Yeah. Inland is more known to be conservative in the real estate space in general, and the DST is more used as a tax deferral. So if you have a highly appreciated property, yes, they could get a better return and they could sell that property and go put it in the stock market. But then they have to think, how many years am I going to have that in the stock market before I get to where I was at with the principal instead of deferring those taxes and getting that 8% annualized return. When it comes to risk, the risk profile, I mean, it's the same risk as you would with any investment within real estate. The properties that we're looking at are institutionalized, stabilized, Class A. We're not looking at any distressed buildings. We're not looking at any secondary or tertiary markets. We're looking at main majority markets where we see the demographic of the United States moving to, where we see individuals moving to, and we see that the markets are projected to perform well in the next 10 to 15 years. We have, a handful of different analysts doing the due diligence and research for these properties before they develop these DST structures. We're pretty picky on which geographic locations and states we get into, and we're also very picky on which properties we get into because we've had so much experience within the commercial real estate space. So, I mean, the risk factors, it's the same risk factor as any individual going into commercial piece of real estate. I wouldn't say it's greater or less when coming into a DST. That's why I just mentioned it's important to exchange with a sponsor that has a great track record, that has experience within this space, because a lot of different things can happen. Inland's gone through the '08 crisis. We've come out of COVID on top. And you can't say the same about a majority of different DST sponsors within the space. There's only about maybe three or four that have survived both of those economic downturns, and are still here today, producing these offerings.
Frank, Julie had a question in regards to minimums, and if I can, I'll jump on that one. Um, Most of the sponsor companies that are out there, Inland, Cap Square, any of the others, they're looking for $100,000 as just a minimum there. I will say, as they get towards the end of their capital raise, they're bringing on 1031 clients. There's usually room to take a lesser number, and I've worked in $20,000. So, but that's, those clients with that kind of a lower numeration, that's usually a boot conversation, dealing with the scraps, leftovers on a transaction. And we can, it's ideal to get hold of us and we can see what we can find that's available to fit somebody in.
Any other questions that I'm missing? Look at the chat box right now.
Yeah, I think you're good.
Okay. Great. So I'm going to touch on the limited personal liability. And this is another great advantage to the DST because when it comes to the 1031 exchange process, like I mentioned earlier, when your replacement, you have to acquire at equal or greater of your relinquished. And sometimes that can come across issues when you have a mortgage left over on your property. Because when you go to sell that relinquished property, let's just say you have $1 million property, the $400,000 mortgage left over, you go and pay off that bank, that $400,000 mortgage, and now you have $600,000 in cash that you have the ability to exchange, but you have to get to $1 million or greater. Typically, there's two things that you could do. You could bring cash to the table out of pocket to get to that million, or you could go back to a bank and get another loan. As we've seen in this previous few years, with the stagnant of the transaction and real estate market in general, a lot of people didn't want to take out additional debt or use additional debt because of how expensive it was to use that. And that can cause issues, especially let's say if you're retired, you don't have enough supplemental income to get a favorable rate. Where the DSTs can come into play is that we have the ability to put debt on these properties that are non-recourse to the investors. So what this means is we typically go out and buy these properties all cash so we can get it to the best price point of our ability. We have a cash reserve on our balance sheet for the ability to go purchase these properties all cash. We then go to a local bank that we have a long-standing relationship with. We get a pretty favorable rate of debt, and then we put different leverage points. So like Rod mentioned, we have DSTs that are all cash or have no leverage, but then we have some DSTs that are 30%, 40%, 50%, sometimes even up to 70% loan to value to help with clients and individuals and investors that have a mortgage left over on their property, but don't want to pick up additional debt on their balance sheet. So what this looks like is with the initial example of an investor client selling a property for $1 million with a $400,000 mortgage left over. So they have a loan to value of 40%. They go off, they sell that property, exchange capitals with the QI. While they're with the QI, Rod now has the ability to show them the platform of DSTs that we have available. So we could have a DST that's all cash. We could have a DST that's 40% loan to value. We could have a DST that's 50% loan to value. They can then identify that DST that has 40% loan to value to acquire the amount of debt that they need to get to equal or greater of their relinquished property to then fully defer the taxes on the gain. And what I mean by this is non-recourse to the investor. If Inland were to ever default on the loan, which we haven't, but if we were to ever, the investor would not be responsible for paying that back. However, they do get the benefits of it. So they get the interest expense write-off and the ability to shelter their taxable income. And if they were to have a property that's fully paid off and they want to utilize leverage to acquire additional real estate, so they have some depreciation expense to help shelter that taxable income too, they have the ability to do that as well. So we have varying different leverage points in these DST portfolios to help mix and match and blend. You could have clients that have a 25% loan to value and utilizing the 3 property rule. If we have an all cash and a 50% loan to value DST, they could theoretically go 50-50 into both to get to that 25% blend that'll allow them to fully qualify and acquire that debt needed. Does that make sense to everyone? This portion can be a little confusing.
Yeah, that makes sense.
Okay.
It's
Great.
interesting. So if if there was a default ever, the investors are not responsible for that.
Correct. Yes, this is a non-recourse loan.
Interesting. Thanks.
Another thing with the DST is diversification. So typically, a lot of real estate investors have majority, if not all, of their property local to where they are because they either deal with the property management, they're dealing with the repairs and the fixes. It's in their market. They like that market. And as great as that is, they're also susceptible to concentration risk. Maybe that housing market specifically within that area performs poorly. There was overdevelopment, and there's not enough demand or purchasing within that market, so prices drop. Well, the DST, like I mentioned, we are nationwide. So we have DSTs throughout different states, and different asset classes. So what this can look like is we could have one DST with 5 self-storage portfolios or properties in Texas. We could have another DST that has 3 healthcare facilities in Utah. And then we could have another DST that's 2 multifamily properties in New Jersey. And your client with that $1 million property could sell that $1 million property, identify those 3 DSTs in the self-storage, healthcare, and multifamily sectors, exchange those 3 different DSTs where they went from 1 property in 1 state to now diversified across 10 different properties in 3 different states, mitigating that risk. And so this could be a good case of point for a client who has 10, 15 properties that you know within your area. And maybe they want to look in different states and different areas. You have the ability to show them these deals that are also off market. You can only access them through ROD to see what we have available, to see where they can diversify geographically and within different asset classes. The next thing within the DST is the estate planning aspect of it. The hardest thing to estate plan around, as I'm sure you guys are aware, is real estate. You can't divvy it up 50-50 between 2 beneficiaries or within thirds between 3 beneficiaries because all the beneficiaries have to decide pretty much unanimously what they want to do with the property once they receive it. Whether that be keep it, operate it, sell it, exchange it, they have to agree. And this can cause conflict within families, especially when we're talking about substantially sized properties or substantially sized real estate portfolios. And how the DST allows the estate planning aspect of it to be easier is because of the beneficial interest percentage aspect of properties. For example, your client, let's say we have a mom and dad with 2 kids. They own a $2 million duplex. Scenario 1, mom and dad pass away. The kids get to step up to cost basis at fair market value, and now they have to decide on what they want to do. Maybe kid 1 wants to sell the property, go put on the stock market, or go purchase a home. And kid 2 wants to keep the property. Maybe it's in a great location, has great return, and he wants to keep managing it. This can cause friction, and it can cause issues, and it's the last thing any parents want, even though they may not be around. But scenario 2, mom and dad sell that $2 million duplex, exchange into a inland DST where they have now 2 million within and are receiving income. Let's say for this example, the life cycle is 7 years and mom and dad pass away in year 4. They will still get the step up to cost basis at fair market value at year 4, and that kids 1 and 2 will receive forced income for the 3 remaining years. Some investors and parents like this aspect of it because their kids are not coming into a large lump sum of money at once. They're receiving monthly distributions and then will receive that large cash after 3 years later. And then upon that deal going full cycle, the kids can each get 50%. So kid 1 gets $1 million, kid 2 gets $1 million. And upon that going full cycle, kid 1 can sell, maybe pay that small portion of tax within that 3-year duration and go buy a home or go put in the stock market or go buy a new car. Kid 2, same thing, could sell his portion, go do as he pleases. He could exchange into another DST or he could exchange into a local piece of real estate. He had the optionality to do what he wants. So it makes the estate planning aspect of real estate much, much simpler and a lot smoother. It allows equal ownership for the heirs. They continue to receive distributions, eliminates the opportunity for the heirs to argue over their inherited property. And lastly would be insurance policy. And I know Rod and I touched on this briefly about the boot left over or also putting the DST as a backup option. Like I mentioned, over the past 2 to 3 years, it's been a little bit of a rough market. And so putting a DST as the second or third property identified allows for a safety net or a backup option in case the initial property falls through. Also, the ability to identify this as a second or third property for the issuance of boot. If there's maybe 150, 80,000, 50,000 left over that the investor doesn't want to pay tax on, they have the ability to do that. So yeah, these are just some of the key benefits of the DST. I can dive deeper and talk about these all day, but I thought I'd just keep this very high level for you guys, and I'll open up the floor to any additional questions. And if Rod, if there's anything that I maybe missed that you want to touch on as well.
They say that if you're a tax person and you pick up a new client and they have a partnership, one of the first things out of your mouth, what you say is partnerships are a good reason for divorce. They rarely travel too far before there's problems. Jonathan, I'll let you jump in on this also. When we're working on a case right now, it's listed at some point it sells. It's two couples in a partnership, and it's $3 million building. They're into it for 1.2, so there's healthy gain in the building's medical office. At some point, it sells, and their intention is to walk towards, with their partnership. They want to dissolve it. They're done. The two couples are done with it, but they're looking for the opportunity to not pay tax. And how do they continue on? And the idea of whopping and dropping has come up, and that's conversation. So Jonathan, that's going to come back at you. But the idea that we've come to is that there is the possibility to take and sell the property in exchange into, say it's a $3 million property, 1.5 into two different DSTs. In the partnership's name. They carry that 2 years, and then they drop the partnership, and each couple goes off with their own separate DST. They've dissolved that partnership. It's a little bit of a time frame, but they've got to go 2 years after that exchange to meet IRS rules, regs, smell test, so to speak. Jonathan, have you encountered much of that?
Yeah, no, Rod, that's a really good point. And it's basically those are the two kind of structuring options where you say, unless you're dealing with an exchanger who's residents of the state of California for federal income tax purposes, the drop and swap is, generally something that's not considered overly risky. California definitely challenges it at the state level. But the drop, essentially what Rod is saying is, my understanding is you've got an LLC that owns real estate, and the real estate's valued at $3 million, and there's 4 members of that LLC, 2 couples.
Yes. Yes.
Yeah. So, and it sounds like both want to have new investment properties. There's no cash out event, right? So that's what minimizes the risk on it. While a drop and swap is considered more of a risky transactional structure inbound to a 1031 exchange. The reason behind that is we talked about qualified use, right? The partnerships owned the real estate investment for purposes of satisfying the code, in the sense that they've owned it for business or investment. When you drop it out, and drop is a way of saying you're moving the asset out of the partnership, and you're then directly titling the property in the name of the former partners now as individuals, pro rata their former membership interest, and now they own as individuals and not as an LLC. And the IRS could say, well, your ownership as individuals is just purely for resale. It's not qualified use. So that's kind of the risk of it. But reduced risk with no partner is cashing out. There's continuity of investment. Both are going to receive like-kind investment property in the form of a beneficial interest in a DST in their exchanges. And so, that's certainly something that they could reduce the risk on for the drop and swap. The swap and drop was the second scenario, where you mentioned, exchanging at the partnership level. So foregoing moving the asset out of the LLC prior to the sale of the relinquished property and having the partnership acquire the DST interests at that level in the exchange, and then following the 2 years following their receipt, then they distribute those beneficial trust interests out of the LLC and into the spousal names or the couple's names. So that could be a method too. I'm not a functionality of that, in a DST. Maybe I defer to Frankie on what that looks like at the at the sponsor level or the management. Effectively, you could dissolve the LLC, but the LLC is going to still be on the trust instrument, and whether or not you could have a transfer from the LLC to the individuals, or what that mechanism would be, if it's an administrative burden at all. But yeah, so that would be a safer scenario without a doubt.
Safer scenario. Yeah. Well, that's it's something that at least can be explored. And half of this conversation with DSTs is, does it work? Does it fit for the clients? And when and where it does, hey, it's a very useful tool for everyone involved. And it's part of it's just the discovery of walking this verbally out for each client. Partnerships always represent a challenge, with dissolution of the partnership. How do you do it and sell property off and not pay tax or be stuck paying tax? And this is just another way for which walking the conversation out, can maybe flesh something out. So, as we kind of work towards wrapping it up, I would offer that, anytime something comes up, whether it be obviously partnership, but there's so many other ways for which DSTs can be a tool, to give call, and absolutely, whether sitting down over a cup of coffee or a phone call or Zoom, just kind of walk it out for how it may be that benefit. And we're certainly not afraid to say, no, it's not either. So it's about doing it right and getting it right. So, Frank, do you have anything else you want to?
Yeah, I just want to leave off this note. I mean, like I mentioned, the ideal client, there's a very small niche of individuals that this will work for you guys. And the ones to keep an eye out for are, one, maybe you have elder clients, older 50s, 60s, 70s. They have real estate portfolio. They're getting old and they maybe do the property management themselves. They don't want to sell because they bought the property 20, 30 years ago for a fraction of what it's worth now. This could be a good recommendation for them. Another one would be an individual who has a very large real estate portfolio, has not been maybe transacting because he doesn't like how the market's been for the past few years, or doesn't want to have additional properties in his certain market. Well, you can show him maybe a couple of DSTs that may be interested to him for him to sell in that market and transact into the DST. And then lastly would be an individual who keeps coming to you, complains about the expenses, the unexpected expenses that are occurring, their tenants that are being a pain, and they're tired of property management. Maybe they're on the younger side, but they just keep complaining about that. That's another client to target and look for. So I would say those are the three main ones that I would keep your eyes out open for. And when you come across them, I think the DST could be a very great solution for them.
Alice,
Yes.
I'll let you take it.
Well, I want to just thank you guys for this presentation. It is really good. I take an online 1031 exchange class every year, and I'll say I picked up stuff in this that maybe just never settled in. And I've been involved in 1031 exchanges, and I know I've talked a lot with Rod, but I feel like now I have a way better understanding of DSTs as well. So it's really been very informative. So I appreciate your guys' time, and all of you guys that sat and listened and asked questions and wrote comments. I appreciate everybody's time. Are there any questions left before I don't want to sign off real quick? I'm going to talk about just the quick Christmas thing. Any more questions? Okay, I'll take that as a no. Many of you are on are a member of the Montana chapter CCIM. Some of you are not because I don't recognize some of your names, but you may be part of Alaska, which might be why I don't recognize your names. But if you want to join Montana, please let me know. I'll get you on the list. It's $125 for the year. We do have end of the year holiday networking event coming up on December 17th. That's a Wednesday. It's in two places. It's at the Keller Williams office from 4 to 5:30. It's open to everyone. You don't have to be a member. We'd like to encourage folks to bring people. 5:30, we're going to go up to the top floor, which is in the same building. Also one of our sponsors, both Keller Williams and Top Floor are sponsors. And so we'll be finishing up the party upstairs at top floor. So we'll be sending that out in email blasts from now until the event, and it'll be posted on social media. If you have any questions, the RSVP is to me, but you can also RSVP to the our Gmail address as well. Anyway, thanks everybody for being with us today. It looks like we're right at our 2-hour point. Boy, that ended up perfect. Thanks so much, everyone.
Thanks, Alice.